Chapter 12, Property Transactions, Non-Taxable Exchanges. As you fully know at this point, generally when there's a sale or exchange of property, there must be some type of gain or loss recognized. There are a few exceptions to that rule. Principally in this chapter we'll talk about 1031 like-kind exchanges and also 1033 involuntary conversions. This is where you are required to give up your property for some reason like eminent domain or condemnation. And then we also have tax-free under Section 121 sale of a personal residence. So those are the three we're going to talk about in this chapter. Like-kind exchange, there's no gain or loss recognized under 1031. If you have a trade or business or investment property, it's exchanged and solely exchanged for property of like kind held in trade or business or for investment. If these provisions are met, you have no choice. There is no gain or loss recognized. So you cannot try to play the system and recognize either a gain or loss that may be advantageous to you from a tax perspective for the current year or for a future year. If you meet these requirements, it is a like-kind exchange under 1031 and you have no choice. If there's a gain, however, it's not that you are not recognizing it at all, but in fact that the gain is deferred when the like-kind until the point when the like-kind replacement property is later sold. Like-kind refers to the nature or character of the property and not to the grade or quality. And what that in the past has meant is just a personal property is considered the nature of the property, so personal versus real property. But it has later also been held that, as you see here under these revenue procedures, depreciable tangible personal property has to be within the same general asset class or product class. So it used to be when this concept first came out, as long as it was personal property versus real property, it met the like-kind classification. But now it also has to fit into the correct class as well when we're dealing with depreciable tangible personal property. Holding period, tax from relinquished property to like-kind property received. So if you have owned a piece of property used in trade or business for 5 years and you trade it for like-kind property, you start the ownership of the property you traded for at the period that you started your original property ownership. So you have 5 years from the original property and you will count that towards the ownership period of the property that you receive. Obviously, holding period pretty much used most exclusively when dealing with figuring out whether something is short-term or long-term capital gain. And since we determined that it has to be for used by or for a trade or business or held by a trade or business in investment, personal use property does not qualify under 1031. We also have these certain types of property that are exempted from like-kind treatment: foreign property, securities, generally currency exchanges, one type of currency for another. Personal property that is not in the same or like class as we discussed there, one type of metal for another, and livestock of different sexes. I know that last one's a little bit strange, but such is the tax code. Under a direct like-kind exchange, you have one owner trading property A for property B. So property A in this scenario goes from Elena to Steve, property B from Steve to Elena. And then we see some of the effects as far as adjusted basis and carryover basis in those two properties go. Now there's also the possibility of a three-party exchange whereby we have three parties exchanging property, and all of the property is going through a qualified intermediary. And you can see there, excuse me, that we basically have property A going from Mark to Robbie, and property B going from Allison to Mark, and it's all being filtered through this qualified intermediary, and you see what some of the effects there are if you follow out that flow chart. Now, to qualify for a non-simultaneous Section 1031 exchange, or in other words, it's not happening concurrently, the exchange for like-kind property, you have to do these three things: sell the relinquished property, identify like-kind property within 45 days. So that has to be, you have to identify what like-kind property you're going to exchange. And then you have to take title to the like-kind property after it's been identified within that 45-day period, within 180 days of the originally relinquished property. Now, when we talk about boot, we're generally talking about cash, but in this case, it could also be non-like-kind property that is exchanged or is a part of a like-kind exchange. So basically, boot in this scenario would be any part of a like-kind exchange that doesn't qualify for like-kind treatment. The fair market value of any of that non-like-kind property is the amount of boot that is required to be recognized, and gain is recognized to the extent that the boot is received, but it is limited to the realized gain in the exchange. And also, finally, that last bullet point is also important. Recipient's basis in boot is the fair market value of the boot. I don't think this flowchart's terribly helpful, but perhaps it will help you a little bit. Nor is that one terribly helpful. Exchanges between related parties. Now, we've dealt with this before in various scenarios and in various types of relationships. In this scenario, when you have related parties that would otherwise qualify for a like-kind exchange, the unrealized gain is recognized by the original transferor. So basically, assuming original exchange occurred between related parties, and the related party sells the property within 2 years of exchange, then the original exchange has to basically treat what was originally an unrealized gain as a realized gain. That gain is recognized in the year of the subsequent disposition, and disposition, because of death or involuntary conversion, is not considered to fall within that 2-year time period. Now, for a transfer of non-like-kind property, the transferor is treated as having sold the non-like-kind property. A gain or loss must be recognized, and of course that is generally the difference between fair market value and the basis, which holds true in this scenario as well. And if it is a personal use asset, then the loss, if there is a loss, cannot be recognized. So nothing groundbreaking in that slide. It's kind of a summation of some of the other concepts we've already talked about with respect to non-like-kind property. Now, under 1033, this is when we have involuntary conversions. Now, a realized gain from an involuntary conversion may be deferred under Section 1033 if the requirements are met. Only gains can be deferred, not losses. All losses, regardless of whether it's a voluntary or involuntary conversion, under 1033 must be recognized in the year of the conversion. These are the three requirements in order to defer gain on involuntary conversions. Obviously, first of all, it has to be an involuntary conversion. Proceeds have to be reinvested within 2 years after the close of the tax year the gain was realized. And that's if it was personal property, not personal use property, but personal property. And if it's real property, then there's 3 years after the close of the tax year. And to qualify again, it has to be qualified replacement property. These are some of the causes of involuntary conversions, not limited to this list, but this is probably the most common types. When there is a threatened or actual government condemnation, and this generally occurs through eminent domain, as long as it is basically going to happen at some point in the future, even if it hasn't happened yet. If it's a for sure thing that it's going to happen, then 1033 is also triggered in that case. And in that case as well, under that kind of exception where say eminent domain is declared, but it's not going to take effect for a year or two, if you sell the property to someone else, not the government, you can still get a 1033 gain deferral selling to a third party. To be qualified replacement property, you have to meet those tests. This is obviously similar to like-kind treatment. That's kind of a summation of what 1033 can do. I won't spend too much time on that. Moving on to sale of principal residence. Now this can be an important provision when talking about tax planning for wealthy clients, especially that may have more than one residence. But this is a sizable and maybe one of the most sizable exclusions of gain on a transaction that there is, and it's up to $250,000 for a single taxpayer, or $500,000 if you're married filing jointly, can be excluded as a gain from the sale of a personal residence. Sale of principal personal residence, it should read there in that first bullet point. Now, principal residence requirement met based on the individual facts and circumstances, and that is an oft litigated point for the IRS, because obviously this provision is kind of ripe for abuse, because it is a tool that can be used very effectively to shield from taxes. But under Section 121, there has to be a sale or exchange. It has to be the personal residence, and it has to be used as the principal personal residence for 2 out of the past 5 years of the owner that is trying to claim the exclusion. If the 2 out of the past 5 years test is not met, there is still the possibility of kind of a pro rata I guess a pro rata amount of exclusion. It wouldn't be the full amount, so it wouldn't be $250,000 or $500,000 for single or married filing jointly, but it could be a proportional percentage of that amount. Also, for the 2 out of past 5 year requirement as principal residence, the 2 out of 5 year requirement is not always required in these unforeseen circumstances that you see listed here. When you don't meet one of those exceptions, the amount of gain excluded, when you don't meet those requirements, is calculated as you see here. These are pretty standard provisions dealing with the recognition and ongoing adjusted basis of a residence. Shouldn't be anything groundbreaking here. Realized gain, as usual, is amount received minus adjusted basis, like you see with pretty much all assets. Adjusted basis in this case, again, is pretty normal, cost plus capital improvements. You would also subtract any depreciation that you may realize, or deduct based on rental use of the property. On rental use, on that note, non-qualified use after 2008 requires you to take a percentage of your excludable gain away if you're using the residence as other than a personal residence for any amount of time after 2008. So you basically take the amount of time that has elapsed since 2008, at least that you've owned the property since that time, and you would take out from the excludable amount, you would deduct that 250 or 500,000 by whatever percentage of time that has elapsed since 2008 that you've owned the property and have not used it as a personal residence. This is generally what the worksheet would look like to file for that exclusion. Pretty self-explanatory there, just saying that the 1033 provisions would cover a Section 121 sale or exchange under involuntary conversion scenario or standpoint. A sale of principal residence, like I said, is a very powerful tax avoidance tool, so it can be very useful in tax planning. Also, possibly avoiding Section 1031 like-kind treatment or not avoiding it, depending on how beneficial that will be to your specific tax scenario. And that's it for this.